Okay, hello everyone, it's William DeBoyk here again doing part 4 on how do you trade Forex for pipjunkies.com here. Now, we're coming to a close here. This is pretty much going to be the last, well, in fact, there's going to be another video after this on the how do you trade Forex section. However, this is going to be the last video of actual major information. The next part of this video is pretty much just going to be sort of warnings and what we recommend people do initially. As after the information that we've gone through so far, pretty much everyone should hopefully be at a stage whereby they'll be looking to sort of be demo trading fairly shortly. Of course, there's still a huge amount of information that we need to cover, and I'm sure if you look ahead on the website, there'll be a lot more videos in regards to this. But like I said, we're sort of starting to come towards a close now with a lot of this information on this particular subject anyway. So anyway, today we're going to talk about the different types of orders involved in trading. Now, as we've already mentioned a few times, there is a number of different ways on how to trade Forex, and the types of orders is going to be very important in regards to this. So there's quite a lot of different orders you can talk about. Now, I'm going to be talking about the major ones, the ones that everyone here will be using pretty much on a day-to-day basis. Any trade you place will involve perhaps all of these orders, or at least some of these orders, combination of the bunch. There is a few others which I'll list on the website below, but I don't think they're really worth mentioning, as 99% of people probably will never, if at all, encounter it. So anyway, let's jump straight into things. So the very basic type of order, the first type of order, the order that most people will be using, the order that most people maybe would have used already or seen already, would be what's known as a market order. Now, as it says on there, in very basic terms, a market order is an order to buy or sell at the best available price. Typically, with a lot of brokers, this is done by a simple click of the button. For example, this just say that we're trying to trade the British pound against the US dollar, so we're trying to trade the cable, and the price currently, I'm just making this up, but let's just say the price currently is at 1.5. I click buy, I am aiming to get in at 1.5, and my broker will allow me to get into the trade as soon as I possibly can. Obviously, I'd set what kind of lot size I want to use for this particular trade, but I just press buy or sell on any particular pair, and bang, I'm in the trade. Pros and cons to this. I mean, the pros are, you can get into the order pretty quickly. Some of the cons can be that, if you're rushing a trade, if you're doing a market order and you're just pressing buy or sell, potentially you could miss out on possible, it may take you a little bit longer to set your stop loss. If the market's particularly volatile at that time, you could end up in a little bit of trouble. Personally, myself, I do a fair bit of market orders. I typically do stop entries, which I'll talk about in just a second, or limit entries. But yeah, market order, simple, very basic. It's getting into the market there and then at the best available price. So whatever that may be on whatever particular pair that you're trading. The next one is what's known as a limit entry order. Now, as you can see in this, is basic. I mean, getting into the market is getting into the market. Okay, I mean it's all the same at the end of the day, but the way in which we do it is slightly different. So with a limit entry order, rather, as you can see on here, I don't know why I keep saying limit. A limit entry is an order placed to either buy below the market or sell above the market at a certain price. So this is basically an anticipation of, once again, we'll go back to that cable example. Say the cable is at 1.5, I might want to buy at 1.4. Now, rather than me sitting there and waiting until the market to come down, or at least anticipating the market to move down to 1.4, obviously going long at 1.4 or buying at 1.4 is better than buying at 1.5. It's a lower price, right? At least in theory. So if the market's moving down, I want to buy at 1.4, but I don't want to stay up all night, or I don't want to sit at my screen all day watching it. I could actually set a limit entry order. Even though the market's currently above that price, I can set what's known as a limit entry order to buy below the current market. And at the same time, if I wanted to sell at, say, 1.6, the market's still currently at 1.5, I could set a limit order to sell at 1.6, which once again, is slightly below the market price at that current moment in time. Now, a stop entry order, this is probably the most common order that I use myself. That may or may not be the case with you guys. It does really depend on what kind of systems and strategies you're using. Once again, I'd like to say, there isn't one that's better than the other, so you don't have to worry about that too much. But the last, well, not the last one, but another one on here is what's known as a stop entry order. Now, a stop entry order is an order placed to buy above the market or sell below the market at a certain price. So we'll go back to the example that we just used. In this case, I want to buy at 1.6 and the market's currently at 1.5. I can set what's known as a stop entry order to buy, because I'm buying it above the market, okay? I'm not buying below. If I was buying below, it'd be a limit entry, but I'm buying above. So it's a stop entry. And once again, if I'm selling below, then it's a stop entry as well. Okay, so basically the complete opposite of a limit entry in that regard. The last one here, and probably the most important one, I mean, you've got the remember this type of order highlighted here. Stop loss order. So a stop loss order is a type of order linked to a trade for the purpose of preventing additional losses if the price goes against you. A stop loss order remains in effect until the position is liquidated or until you cancel the stop loss order. So, for example, once again, we'll go back to this cable example. If I place a trade at 1.6, say I'm going long at 1.6, I may wish to put my stop loss at 1.5, so 100 pips below, right? Actually, no, it wouldn't be 100 pips, it'd be 1,000 pips, wouldn't it? But anyway, yeah, you know, you put your stop loss below there at a particular price, and basically, if the market hits that, it's basically you just saying, okay, enough's enough. The trade didn't work out. I've hit my stop loss. So whenever you hear someone referring to hitting their stop, and most people will just say stop. Very few people actually say stop loss. Traders are very lazy. Adding the word loss onto the end of a sentence can make things very confusing by the sound of things. So, you know, if you hit your stop, it's basically you just saying, okay, fine. You know, the trade didn't work out. You know, some people will set stops based on how the charts look. Some people just do it by a pip value. So people will say, okay, my stop is 10 pips. So, you know, if the market goes 10 pips against me, bang, I'm out of the market no matter what. And that's basically what a stop loss order does. Now, personally, and I'll be going to this in more detail in the next video, but stop loss orders are the most important orders of anything that you can place. As I mentioned, I'm sure previously in these videos, you know, managing your risk is the most important thing. No matter what you do, managing your risk is key. It really is key. And I know you guys are probably bored of me hearing say it, but you know, you'll either find out the easy way or the hard way. You can either listen to me or you'll find out for yourselves eventually, I'm sure. But stop loss order, most important. It just stops you from losing too much money at the end of the day. So that's basically what it is. Once again, you know, this will all become much more clear once you play around a bit yourselves and come into things. So the last order I'm going to talk about is what's known as a trailing stop. As it says on here, a trailing stop is a type of stop loss order attached to a trade that moves as price fluctuates. So for example, I could set a stop loss order of 20 pips. So basically that will mean that every time the market moves up 20 pips, my stop will follow that. So let's just say I place a trade, yeah, and I've got a 20 pip stop loss, and I also add a 20 pip trailing stop. Once I'm up 20 pips, my trade will automatically move to break even. So the highest point that you're up, every 20 pips, okay, this can go up in increments, the market will automatically cap in below it. It trails, hence the name trailing stop. It trails below it. So say I'm up 21 pips, the market will then lock in that extra pip, right? Because 21 was the highest, it can then move up 20 behind it. So I would then I'll be guaranteed 1 pip. If the market moves up 100 pips, I'm guaranteed 80 pips. It's always 20 below, okay? So a trailing stop. Trailing stops are good, you know, I mean, I personally don't really use them that much. There are a lot of systems that do use them, and you know, you guys I'm sure will come across them at some point or another. But yeah, you know, it basically just allows you to lock in you know, any potential gains that you are making at that particular time. As always, trailing stops can go for you, they can go against you. For example, if my stop was 20 pips, the market might move up 100 pips, it may then pull down 30 pips. Obviously by that time I would have been stopped out, right? Because I've only got a 20 pip gap between the market and my stop loss. The market moves down 30 pips, it could then fly up 1,000 pips, you know, and I got stopped out because of my 20, and you know, potentially could have made a little bit more. That's probably not the best example in the world, but hopefully you get the point I'm coming across. So anyway, that'll be it for now. That's all the information I wanted to cover in this particular video. Like I said, look out for the next one because we're going to be kind of rounding things off, and then we'll be moving into the exciting stuff. We'll be talking about technical analysis and how people can actually get involved in trading, what you need to look at, what you need to do, what information's good, what information's bad, etc., etc. So anyway, yeah, that's pretty much it for now. As always, any questions, let me know, and if not, I'll speak to you guys in the next video. Thank you.